Hi students, this video will look at cost of capital. It's one of those important things that you need to use when you decide whether or not to take on a project. So it's something that you might use Excel for, and if you don't, you'll probably use a similar software, but doing it shorthand might be just too complicated. This video will cover cost of capital. Cost of capital is a necessary economic and accounting tool that calculates investment opportunity cost to maximize potential investments in the process. The cost of capital is tied to the opportunity cost of pouring cash into a specific business project or investment. Once those costs are evaluated, businesses can better make decisions to deploy their capital to maximize the potential profit. Loosely defined, it's how to structure, how to pay for stuff. It could either be using the cost of capital can involve debt, it can use equity, or it could use another source of capital. Overall, it's all about focusing on the opportunity cost that you might forgo when you decide between project A or project B. A simple way of saying it is that cost of capital is the minimum rate of return an investment project must generate in order to pay for its financial costs. For a leverage firm, the financing cost can be represented by weighted cost of capital. That means that they have raised funds through equity, debt, and maybe issuing a bond. Sometimes preferred stock is an alternative as well. One equation that is used is where K equals the weighted average cost of capital, and K1 will be the cost of equity capital for a leverage firm, and I, right there, is the pre-cost cost of debt, and then the debt to total market value ratio and marginal corporate income tax rate. And that way you can compare the cost of capital and weigh it based on not only the cost of it will be like the interest rate or required rate of return, and how it's taxed. So a firm that can reduce its cost of capital will increase the profitable capital expenditures that the firm can take on and increase the wealth of the shareholders, maximizing shareholder value. Sometimes taking on international projects will lower the cost of capital and increase the return, and sometimes this would be a representation of minimizing risk. Naturally, there will be differences in the cost of capital in different countries. The cost of capital investing in the Philippines would be higher than that of doing an investment in, for example, Switzerland. Now, what comes into that risk is the political risk, and you might have to add a risk premium to that. But overall, by diversifying and having business units in different countries, you not only get access to doing business in those communities, but you can also overall lower the standard deviation and the risk involved in doing business on a global basis. That's why some businesses choose to have manufacturing in a lot of different countries. Another way of lowering the cost of capital is cross-listing your stocks, or if you're a publicly traded company, that is. That means that you would cross-list your stock so it's traded on many other exchanges, and that way when you have employees working in different countries, they can also earn, for example, stock options. And because the company is listed on the exchange, typically it needs to follow a lot of strict rules, which means that you can have a better credit rating by following these rules as a side effect of the whole part. Overall, it will then result in a lower cost of capital. Cross-border listing of stock benefits a company in the following ways. 1. The company can expand its potential investor base, which will lead to a higher stock price and a lower cost of capital. Number 2, Cross-listing creates a secondary market for the company's shares, which facilitates raising new capital in foreign markets easier. Number 3, cross-listing can enhance the liquidity of the company's stock. Cross-listing will also enhance the visibility of the company's name and its products in a foreign marketplace. Cross-listing stocks typically is very welcomed in a country. Now, naturally, having a cross-listing of your stock do carry a significant amount of cost and administrative work. Compliance is always a big part. It can be costly to meet the disclosures and listing requirements imposed by the foreign exchange and regulatory authorities. Once a company stock is traded overseas markets, there can be volatility spillover from these markets. Once a company's stock is available to foreigners, they might acquire controlling interest of this company and challenge the domestic control of the company. Overall, the cross-border listing of stocks appears to be a very profitable decision. So most of the time, the benefits always outweigh the costs. Dear students, I hope you liked this video. If you did, please subscribe by clicking up here and give me and maybe even write a little comment down below. So I appreciate your help and your support, and I hope you enjoy these videos on finance.